Good afternoon, ladies and gentlemen. Welcome. My name is GBay99. I hope you all are having a wonderful day. Today, we are back with a very exciting series. Over the course of the next 7 days, I'm going to be putting out an investing week. This is going to be the week of investing, the week of finance, talking about all sorts of fun individual things surrounding the world of money, finance, how to get rich, and all that kind of jazz. I want to start this off by saying this is not financial advice. Go consult a professional financial advisor before you make any big decisions or yada, yada, yada. This is for education and entertainment purposes only. Don't take my advice too seriously because I'm just a goofball. But with that being said, disclaimer out of the way, I think that for the most part, a lot of people out there are not very financially frugal. They aren't financially smart. I don't know. Most people are financially uneducated. They don't understand what to do with their money. They make bad financial decisions. They get, they're swarming in debt or whatever, and they kind of just feel like, oh, capitalism is so unfair. Young people in particular, I don't really understand, have this really weird anti-capitalism thing when they don't quite understand how certain stuff like investing and everything can benefit themselves. And it really can benefit you quite a lot when you're young. We're going to be talking about a few things, a few rules of investing that you may or may not know, a little bit of a guideline for where you should go in you watching this right now. Wherever you are in your financial journey, how you can go from where you are to a goal of hopefully eventually becoming financially independent and retiring, and how you can do that regardless of how much money you make. A lot of people think that, Wall Street is just for the rich fat cats who have millions of dollars to throw around. It's really not for just those people. You can make a lot of money yourself, even if you make barely anything. And that's what we're going to be talking about today. Before I get into any of the individual things, though, any of the individual points, I want to start this off with a little bit of an anecdote. I read a while ago, I forget where I saw this, but I read a while ago something very interesting where someone said, most people don't want to be millionaires. Most people want to spend $1 million. When you think about a millionaire, I'm sure your mind conjures up images of big fancy houses and Lamborghinis and here in my garage, right? That's what you think of when you think of a millionaire. But there's probably a lot more millionaires in your life than you realize. Now, this kind of depends on where you live and where you might live on the financial ladder. But if you know individuals or grandparents or whatever that have retired, pretty much anyone that's retired likely has probably about $1 million in assets. Millionaires aren't exactly all that, they aren't all that sparse. I know that the top 1% owns 99% of the wealth or whatever, but for the most part, a lot of people that are pretty middle class or upper middle class are technically millionaires, but you wouldn't think of them when you think of a millionaire, because when you think about being a millionaire, you think about spending $1 million. But when what I want you to start doing, if you want to build towards that sort of financial goal of retirement and financial freedom and everything, try and start thinking of being a millionaire as someone that's frugal, the opposite of what you would think of. Someone that saves a nickel and dime here and there so it can grow over time. That's really what it's all about. And again, regardless of where you are on the financial ladder right now, you can get to, you can abuse all the systems that all the rich people do to get to a pretty impressive point. And we're going to show you guys an example of that right now. So firstly, it's much more important to invest when you're young compared to when you're old. And this is something that I want, if there's nothing else you learn from this video, please understand what I'm about to show you right now. Compound interest is the most important thing that you'll ever learn about in your entire life. Albert Einstein once said, this is not a fake Einstein quote. Albert Einstein once said, compound interest is the strongest force in the universe, okay? And it really is. Take a look at this. So this is a compound interest calculator. I might remember to leave this in the description. I'll leave a link to this in the description down below. So let's say that you go and you get $500, right? Let's say you get $500. That might be a lot of money to some of you, but it's the kind of thing that you could probably save up over the course of a year, even if you're not someone that's very well off right now. I think the median income of a family or the median income of a household in the United States right now is somewhere around $30,000. I don't know if that's before or after taxes. I think that's after taxes. But anyway, if you have an income of like, I don't know, $30,000 a year, $25,000 a year, you can likely save $500 over the course of a year. You could probably save $500 in a single paycheck, right? I mean, that's half the cost of the new iPhone. If you just cut back on your spending a little bit, you'll find $500 laying around. If you go and invest that $500 into the stock market, let's say you invest into the S&P 500 ETF, that'll probably give you about a 10% rate of return. Over the course of 50 years, that $500 is going to grow to $72,000. All right. That's a lot of money. And that's an example of how a very small amount of money can grow into a huge, huge amount of cash for you if you just let it sit over time. And that's the key, is to letting it sit over a long period of time. A lot of people, one of the best pieces of advice you're ever going to get is time in the market is a lot more important than timing the market. Because over the course of 4 years, 12 years, 20 years, you're not really making all that much. $500 is only going to give you $110 in this example over the course of 4 years. That's really nothing. That's a nothing burger, as Kevin O'Leary would say. $110, that's like, okay, yeah, $100, but to sit around for 4 years just to get $110, that's not really all that impressive. But you can see that the thing about compound interest that's interesting is that while, at first you only make 10% of $500, that's $50, right? If you make $50 in 1 year on 10%, it's like, okay, that's nice. But then you have $550, that 10% of that is going to be slightly larger, and it compounds on itself in that sort of way. This is just one example, though. You can start really building this to incredible levels of wealth if you do a few things. Like, let's say you have $500, but you also have a monthly deposit where you're able to save $100 a month and add that into your investment over the course of every month, same period of time. How much money do you make there? Well, then you make $1.8 million over the course of 52 years. That's a lot of money, okay? You are depositing a lot over time. $60,000 is how much you end up depositing over the course of 50 years, but it's only $100 a month and $500 that you're starting off with, and you grow that to $1.8 million. Like, this is something that is very attainable for young people nowadays, right? I mean, this is not all that difficult to reach. To find $100 here and there to save, as long as you're an employed individual, whether you make a lot of money or not is not really that big of a deal. And let's say you are someone that's, you're not making a minimum wage job where you can only save $100 a month. Let's say that you go and you're someone that, I don't know, you graduate college and you get a nice paying job of $40,000 a year or $50,000 a year, $60,000 a year. That's still pretty middle class. That's not exactly someone that you would think of in the top 1%, even if that might be like the top 25% of earners in the United States. I would wager that if you're listening to this video right now, if you have internet access and you can, own a computer and stuff, that's probably something that's pretty attainable for you. What if you can save $1,000 a month that you deposit into an investment account? Well, then, over the course of 52 years, you get $17 million, okay? Again, you're not making that much at first. I can't even hover over the first 12 years to see how much you're making, but you can see that the fact that it compounds on itself so much is really where you get crazy levels of wealth, even if you're someone that's just saving a little bit of money. And then, of course, if you go and let's say you're someone that actually gets a really high-paying job. You go and get an MBA or something, so you can get $100,000 a year, $200,000 a year, get some sort of crazy salary. Then you can get $173 million. Like, yeah, that's how you can build a lot of wealth, regardless of where you are. Whether you're putting aside $100, $1,000, $10,000, you can reach millionaire status without being born into the Walmart family or whatever. So anyway, this is something that I know a lot of people might point at the 10% interest rate, and they'll say, okay, 10% interest rate, that seems kind of high. Can you really make 10% over the course of 52 years? 10%, that's way too high. What about a stock market crash? What if we have another 2007, 2008 financial crisis that sends the economy into a recession? Well, yeah, that's true. The stock market doesn't get 10% every single year. The S&P 500 index, this is a good index that often measures the stock. Most people would say that this is the best way to measure the U.S. stock market. That gives the most exposure, while Dow Jones normally has mostly industrial stocks, and the NASDAQ might just mostly be tech stocks. The S&P 500 covers quite a bit of the U.S. stock market, and you can invest into an S&P 500 ETF. Ticker SPY or VOO, I think, are the two most popular. And let's go ahead and take a look at returns, right? So the S&P 500 took off in the year 1970. And let's say right here, if you can see, this is the value of a single dollar that was invested when it first took off. All right. So at first, you don't make anything. You only get a 0.1% interest rate like that. Okay, you don't get anything that first year. You go from $1 to $1.04. Next year, you make a little bit more, 10%. That's pretty nice, and that compounds on your 1.04 that you make in the first year to get to 1.119. All right, next year, another pretty good year, 15%. That's pretty good. You go up to $1.41. But then you have a crash. 1973-74, you have 2 awful years where the stock market does horribly, and after those 2 years, you're actually below what you originally put in. That's not good, right? You over the course of 5 years to put some money into the stock market, leave it there, and then you see that you've had less money than what you did previously. That's just got to be heartbreaking. But you're not in it for the short term. You're not trying to see what you can make in 4 years or whatever. You're trying to invest for your future so you can retire and become financially independent. And you can see that it always recovers. You will always make money. Over the course of 25 years, all right? Over here on the right, this column, this is the annualized return over a 25-year period. So how much interest you make on average over the course of 25 years every year. 10%, 12%, 12%, regardless of when you invested. 12%, 13%, 17%, 9%. The worst that you could do, the worst that the S&P 500 has ever done over the course of a 25-year period is 9.15%. That's pretty damn close to our 10% rate of interest, right? That's why you want to, time in the market is a lot more important than timing the market. As long as you're not in it for the short term, you can invest, and over a long period of time, it doesn't matter how many crashes you have, right? Even right here, 2014, this 9% or 10% in 2013, that includes the 2007-2008 financial crisis, where stocks lost 38%. That includes the dot-com bubble of 2000, 2001, and 2002. That was like a 3-year recession. And that also includes the 1990 recession when Iraq invaded Kuwait and caused oil prices to skyrocket. That includes multiple crashes in the stock market and multiple recessions, and you still get interest as long as you have a long period of time. Time in the market is more important than timing the market. So that's the number one thing that you should really pay attention to. Investing. It's good. It's good for you. You will make money over a long period of time, whether you invest a lot or whether you invest a little. Compound interest is beautiful. And that's the number one thing you should take away from this video. But let's go ahead and get into some more specific things. I'm gonna give you guys a couple of rules that I don't know if you've ever heard them before, but if you haven't, try and abide by a few rules here, right? I don't know all of the rules that you're supposed to have, but there's a few things that you should really try and follow. Save 10% of whatever you make, whatever your monthly income is after taxes. Try and save 10% of it. That shouldn't be too difficult, regardless of how much or how little you make. Obviously it's easier if you make a lot of money and you're you're not living beyond your means. But everyone, regardless of where you are on the ladder, you can save a little bit here and there. Try and save 10% of what you make after taxes every month. Also, don't spend more than a third of your income on housing. This is something that you actually won't be able to get a home loan if you can't prove that the mortgage you're going to be paying is going to be like a third of your income. It might be 40% or something for a mortgage because they do want to give mortgages to as many people as possible, but you should really try and not, a lot of people complain about high rent prices and everything. It might be kind of sucky. You might have to get a roommate. You might have to get an apartment that's not super nice, but you should try and live within your means. Don't live beyond your means so you can save that little bit of money to invest as time goes on. That's really what you should be trying to do. But let's go ahead and talk about what you should do with your money. This is a little guideline that you should try and follow yourself. I don't know where you personally might be on it. And of course, I also understand that a lot of people that watch my videos aren't living on their own right now. So if you're still in school or something, then this doesn't exactly apply to you yet. But here are the staple rules of like where you should go when investing. Number one, first thing you do at the very beginning of your journey is save $1,000. Save $1,000 for a rainy day fund. If your car breaks down, if you have some sort of medical expense, if you have some sort of, accident or whatever, or, whatever it is that might blow up in your life, save $1,000 so you can have a little bit of a safety net. That's the first thing you should always do. After you save $1,000, start paying off your debt. If you have student loans, if you have credit card debt, whatever it is, start paying off your debt. However, one thing that you should know that a lot of people don't know that's kind of infuriates me when they don't know it is don't pay off debt where you have a really low interest rate. So I'll give you an example, right? If you get a home, most mortgages, at least recently in the past however many years, 25 years, or even right now, if you go and get a mortgage, you'll likely get somewhere like a 4%, 5% interest rate on your mortgage. And that 5%, a lot of people use mortgages as like, oh, banks are so greedy. They go and steal our money by giving us mortgages. We're just renting our houses and the banks can come and take them from us. Mortgages are a great thing. You should never pay down extra money to your house because that 5% interest rate is nothing. You can get 10% from the S&P 500. If you go and you pay off a mortgage, early, let's say you go and put $1,000 towards your mortgage. Yeah, you're saving a little bit on the interest, but if you went and put that $1,000 in the S&P 500, then you would have made a lot more than what you're saving with your house. And again, over the course of a long period of time, you're saving overall. That's an example that a lot of people don't understand. A lot of people try and say, oh, you're just making the banks rich by getting a mortgage and you have to pay all this money to the bank. A mortgage is a great thing. Don't pay extra money. If you have a low interest rate on a loan, I'm not too sure about student loans because I never got a student loan myself, because I dropped out of college. But, if you have a mortgage, I have a mortgage that's like a 4.25% interest rate. I will never pay anything extra down on that. If I have a car loan as well on a car, it's like a 1% interest rate. Why would I ever pay down a 1% interest rate on a car loan when I can go and stick that extra money that I would be paying that off by putting it in the market? I don't know about student loans. Student loans might be around like 7% or 8%. If you're getting to a point where you're getting close to like that 9% that the S&P might do, then it's kind of understandable. It's negligible. You might want to pay off those student loans because it would be nice to get your loans. When you're paying off a loan, you're basically getting a guaranteed return on that money, right? So if you have $10,000 in student loans at a 7% interest rate and you pay that off all at once with $10,000, then you basically got a guaranteed 7% return on your $10,000 investment. And you should start, once you start getting to higher interest loans, then that's when you want to start paying them off. But so anyway, starting to get off track here. Start off $1,000 savings. After that, pay off your debt, but only pay off the high interest debt that you have. Pay off your credit cards. If you do have a student loan that's high interest, pay off your student loan. But just that high interest stuff, that's what you mean when people say pay off your debt. Don't go into debt. It's totally understandable and fine if you want to go into debt, get a mortgage for a house. It's actually much better for you to get a mortgage for a house rather than to pay cash for a house. So do that. That's what you should do. Okay, hopefully you understood that. Good debt versus bad debt. Only pay off the bad debt. Don't pay off your good debt. After you get your debt paid off, though, after you don't have any more credit card loans or whatever, then you want to go and start putting money into your savings again, and you want to save up about 3 to 6 months. You want to save about 3 to 6 months expenses, right? So calculate your monthly expenses, whatever your rent is, your food bill, for your groceries, your car insurance, your car payment or whatever. Like whatever your monthly expenses are, get 3 to 6 months of a chunk. So if you lose your job, you won't be stressed. If you lose your job tomorrow and you suddenly have to go find a new job, you'll be totally relaxed because you can live for 3 to 6 months without ever needing to make another dime. So you have a very long window of opportunity to go and find a new job. Personally speaking, I actually take that money and invest it. I've been trying to save up like a 12-month expenses. This is just what I do. This is not advice. A lot of people would say this is bad advice, but I've taken my safety net and invested it into the S&P 500 because I feel like, stock's the worst thing that ever happened. I think the worst drop that the stock market has ever had is like 40% or 50%. If stocks drop 50% during a crash, I'll still have 6 months savings because I'm trying to save up for 12 months, right? So if stocks ever drop that much, then okay, that'll be kind of sucky, but they will recover. And if stocks somehow drop more than 50%, if I somehow lose all of that money, then I feel like that would be like the end of the world, right? That would be, we would have much more problems than just, how I'm going to pay my bills in 12 months. Anyway, though, that would be like end of the world, right? But anyway, that's just personally what I do. I have a little bit more than that in a safety net, and I have that invested into the S&P 500 just so I can take advantage of my young age and the compound interest and everything. So, if I have an emergency, I can usually pay on a credit card, right? If my car breaks down or something, or if I have to go get a repair, I can pay that with a credit card, then just sell a little bit of that stock and then, pay it off. Again, that might not be good advice. That's just what I do. Anyway, after that, though, once you have your savings, next thing you want to do is start taking advantage of tax-advantaged accounts. So if you have a 401k, where your employer will match a contribution to your 401k, you should take advantage of that. You should take advantage of an IRA. You can set up an IRA account yourself, whether you have all sorts of different retirement accounts where they have different tax advantages. So, different IRAs and different 401ks have different rules and everything, but generally speaking, you will get a big tax break if you invest into those various accounts versus just going and investing stuff on your own. So you should try and max out those tax advantaged accounts after you have your savings. And then after that, that's where you get to start being a little bit riskier and having a little bit more fun. Personally speaking, I try and invest mostly myself. I try and invest in a mixture of stocks and bonds. A good rule for you is to own your age in bonds. That's generally speaking what most people say is like a good rule for risk management. Because when you're younger, you can be riskier. When you're young, I'm 24 years old. I can go and invest almost entirely in stocks. And, if stock markets crash, then that's fine because I'm very far away from retirement, so there'll be plenty of time for them to recover. But once you start getting older, once you're in your 50s and 60s, then if stock markets crash, that might kill your ability to retire. So you don't want to be completely allocated in stocks. You want to have a large portion of your money in bonds, government bonds. Bonds are generally speaking something that's considered much safer. Most people think that the U.S. government is not going to implode tomorrow and stop paying its debts because the U.S. economy is the strongest economy in the world. Bonds, they don't really give very good interest rates. A yield on like a 2-year treasury bond is like 1% or something. The 10-year is only at a 3% right now. A 10-year treasury bond only gives you 3% interest. And as you just saw, you can get like 10% a year in the market. But once you start getting older, you want to start moving your money into those safer spots. You want to move into bonds. You also might want to move into CDs, which is like certification of deposit. That's something that you can do with a bank where you'll have a set period of time, like 12 months or 18 months, and they'll give you a 1% rate on money. And that's something on any sort of money you put in. And that's something that you can do if you know, like, okay, I specifically need money at a certain point in 12 months or something, and I can park that in a bank. So yeah, there's a number of different safer options. You should generally look towards those safer options. Once you get older, you will get much less of a rate of return, but it's important to be much safer when you're older so you don't have all your money wiped out when you only have a couple of years left to retirement and a stock market crash might actually really hurt you. There's a number of different riskier plays that you can do when you're young. I'm really enjoying it myself. I'm trying to, again, keep a lot of my money just invested into the S&P 500, but you can also go and start picking individual stocks. That's obviously much riskier because individual stocks can be completely wiped out. There's examples that I can think of streamers and other individuals that are young and invested and lost $123,000 because they invested in a single stock that ended up going up bankrupt. So you should try and diversify to whatever your risk tolerance is. But generally speaking, the younger you are, the more you can play with stuff like cryptocurrencies or various different, stock picks and individual risky investments where you might lose a lot because you have a long period of time in your life to make that money back through income and for markets to recover if there is some sort of crash. But anyway, those are generally the rules. Those are the rules for investing that I personally follow, and you can choose to follow them if you want, but don't sue me if you lose money because this is not financial advice. I'm not a financial advisor. I don't know what I'm doing. I'm just a goofball. But yeah, this is all really exciting stuff, particularly if you're young, even if you're like under 30 or under 40. You can really make a lot of money just through being smart, just through being financially frugal, investing in a few individual things like the S&P 500, and just letting your money sit. And even if there's a crash or something, that's going to be sucky for that year or for those couple of years. But over a long period of time, you can build a lot of wealth, even if you're young and not making much money right now. It's a mindset above all else. Again, don't think about it like, oh, I'm getting all this money so I can go and be a millionaire and spend it all on Lamborghinis in my garage. Just try and think, we're trying to build wealth here. I'm trying to give myself a safety net. I'm trying to build towards financial independence, towards a goal where I can not have to worry quite so much about life blowing up in my face. And I hope all that gave you guys a little bit of interesting advice, and I hope you learned something with today's video. I will be back tomorrow with our next video, where I forget what tomorrow's video is going to be on. Tomorrow's video I might talk about some of my personal individual investments, because that's kind of fun. I enjoy going and picking individual things, picking individual stocks, and even if I lose a lot of money or lose some money, it's still really fun to feel like you're the owner of a company. That's something that I really don't understand why young people are so like anti-capitalism. Seizing the means of production, you can go and own the means of production if you go buy stocks. Anyway, though, before we go off on a rant or anything, I'll go ahead and cut the video off there. I will see you guys tomorrow. Hope you guys enjoyed today's video. Hope you're looking forward to tomorrow's. But until then, thank you very much for watching. Good luck in solo queue, and have a wonderful day.